In a world where Bitcoin's bigger, right? If it starts to approach its total addressable market, maybe 40% of people own Bitcoin. It's one of the major currencies. It's used, and it's kind of now slowly settling at that like high level, that like plateau of adoption. You no longer have that kind of exponential move upward. Instead, basically, you have a scarce unit, and as technological production gets better over time, most things should get gradually cheaper when denominated in Bitcoin.
Hey guys, welcome back to Everyday Finance. In this video, Lyn Alden discusses about Bitcoin. Lyn Alden says, the value of each individual Bitcoin and the total market capitalization of Bitcoins has increased dramatically during the last 10 years. Let's say as a result, prices dom and Bitcoin collapse, but it's in a world where the cryptocurrency is more popular. And if it does start to approach the total adjustable market, perhaps 40% of people will own Bitcoin. It's one of the major currencies. And it's currently kind of settling at that high level, that like plateau of adoption. Instead of an exponential move upward, most things should gradually become cheaper when done in Bitcoin over time. As most things should as technology advances, become scarcer for instance. Since 1960, the US money supply has grown at an average rate of 7% a year. And when you look at what constitutes inflation, things like water from properties or fine art generally went up roughly in line. And lots of things Lyn Alden discuss, so please watch the video to end. And share, subscribe our channel, Everyday Finance. Thanks.
So right now, Bitcoin is in an early phase of its adoption. So when it goes from say 0.1% of people own Bitcoin to 1% of people own Bitcoin, and then it goes to 10% of people own Bitcoin, you get that hyper deflationary force, right? So the value of every individual Bitcoin and overall Bitcoin market cap goes up, exponentially, let's say over this past 10-year period. And so prices denominated in Bitcoin collapse. But in a world where Bitcoin's bigger, right? If it starts to approach its total addressable market, maybe 40% of people own Bitcoin. It's one of the major currencies. It's used, and it's kind of now slowly settling at that like high level, that like plateau of adoption. You no longer have that kind of exponential move upward. Instead, basically, you have a scarce unit, and as technological production gets better over time, most things should get gradually cheaper when denominated in Bitcoin. As an example, over the past, since 1960, U.S. money supply growth has been about 7% per year on average. And when you look at, say, what has inflation done, right? So things like waterfront properties or fine art generally went up roughly in line with the money supply growth, because these are finite things. And so as we made more monetary units, they went up at roughly the same pace in terms of price. Now it's a bumpier path. There could be bubbles or depressions in those assets, but over a multi-decade stretch, that's roughly the rate that they grew at. And when you go down to a little bit less scarcity, things like gold. So gold was growing at about 1.5% per year, as far as estimates can tell during that period. And median houses. So houses are an energy-intensive, labor-intensive thing to build, but we can build more of them. Or oil. So oil is challenging to get. It takes a lot of infrastructure and resources to get, but we do get better and more productive at finding and extracting oil over time, with shale being an obvious example. And so those types of things generally went up not as fast as money supply growth, but they went up faster than the official CPI readings. And then there's things we got exponentially better at making. So 1 gigabyte of memory, for example, storage. I used to be excited when a computer had 256 megabytes of RAM, right? And so as we've gotten way better at electronics, anything Moore's law related, software, offshoring, industrialization, a lot of those things were outright deflationary. We just got exponentially better at making them. So what is the cost of taking and storing a picture today compared to what it costs, even when I was a kid, and I'm not that old, right? So that type of thing has really weighed down the CPI basket. So inflation is this spectrum that exists where some things we can't make any more of, some things we can make some more of, and some things we get exponentially better at making. And so in that sort of world where either gold or Bitcoin is money, most things generally get cheaper over time versus those things, right? So, if you look at, say, gold price and oil over the past century and a half, it looks like a big zigzag line, right? Whereas if you look at oil priced in dollars, it goes, it's got these occasional huge bursts and the new plateaus and another burst higher. It goes up like 100-fold over 100 years. And that's because it's the underlying unit. And so when most things are kind of equal to down versus gold over the long arc of time, and with Bitcoin that has even zero supply inflation, you have slightly more price deflation than you have in gold, something by like an additional 1.5% more, because you're comparing zero to an average of 1.5%. And so in that world, most things on average get cheaper over time, not necessarily every single year, but as long as civilization's advancing, as long as technology is getting better, you'd expect most things to, or at least some things, to gradually get cheaper when denominated in your Bitcoin.
I asked this question to Lyn Alden. So Lyn explained the Bitcoin technology to me, as you are aware. And as we shall see, I am not at all technologically savvy. However, I am reading this online. Please correct me if I am incorrect. But according to Google, Bitcoin processes approximately 7 transactions per second. In contrast, Visa processes approximately 1 transaction per second. You just wrote about Visa on your website. All investment strategies are guided by research, so Visa can process 24,000 transactions per second, while Bitcoin processes 7 transactions per second. Therefore, if the entire globe uses Bitcoin, can its network handle the volume of traffic? Manage that amount of traffic, and how can you have faith in a third-party entity like the Lightning Network? And there is a cryptocurrency venture that advises, hold on, to do it. I mean, why would that be considered as something more reliable to rely on than, say, JP Morgan or the Federal Reserve?
So I think the most direct comparison is Bitcoin to Fedwire. So if you look at the Fedwire system, it's a settlement system in the United States. It settles, and this is not like a typo, 1 quadrillion worth of gross settlement volumes per year. So 1,000 trillions. And it does that with these almost exactly the same number of transactions as Bitcoin does. So it's got something like 7 transactions per second. Unlike Bitcoin, it doesn't work around the clock. So those transactions are consolidated during business hours. But the way it works is that you have an average transaction size of like 5 million, and you have 200 million of those a year, and so you get a quadrillion worth of settlement volumes. And then you have other things that are built on top of that, and they can batch transactions and send them over these settlements. And so Visa is not a direct comparison to Bitcoin, because Visa is a layer on top of a system. So they're a signaling mechanism for banks to settle and for the underlying unit of account to do what it's going to do. And so with Bitcoin, we've generally seen a direction similar to that so far. And this really happened over the past 5 years or so. We have a breaking into various layers. And you still the underlying base layer, that's like your gold and Fedwire combined into one system. So it's both the units and it's the ability to settle those units and verify those units. On average, it's a 10-minute plus transaction time. And as you pointed out, you're limited to roughly what Fedwire currently does, which is a pretty large number of transactions, but not big on the global scale. And then you have higher layers on top of that are able to process a lot more transactions and then settle back to that. And so Lightning, to clarify, Lightning is not a third party. Lightning is another open source technology. All it is basically 2 of 2 multi-sig channels on top of Bitcoin. And so unless there's a technical bug, there's no custodial risk that you're taking on by using Lightning. You're taking on some degree of, you're, instead of having your Bitcoin in cold storage, it's in hot storage, but it's non-custodial, right? So far there's been very limited numbers of people that lose Bitcoin on the Lightning Network, because it's more of instead of a big centralized custodial honeypot that can get taken, it's more like you can have individual channel issues and things like that. But basically you're making these smart contracts in order to send value over very quickly. And so you can scale with that method. But then in addition, you also have things like Cash App. So in Cash App, for example, any Cash App user can send Bitcoin basically for free, I think, to any other Cash App user. And you're just using Cash App's ledger. right? And so in some sense, you have to trust Cash App. But then, of course, Cash App could do things like proof of reserves. You can also, there's Liquid, which is currently not really well used, but I think it's a model of thinking about this. So in Liquid, you have like 15 entities that run a federation, and you can peg Bitcoin into it. And then a Liquid Bitcoin, it can settle way more transactions per unit of a time. It's also more programmable. And then you can peg out. And in order for that to fail, either you'd have to have a catastrophic technical bug of some sort, or you'd have to have the majority of those federation entities steal from you. So not just one entity, but you'd have to have a majority of entities kind of grouped together to steal from the users of that system. And of course, at that point, you can have legal recourse and things like that. So basically, in this kind of world that we envision here, at least as like a thought example, you have the underlying base layer, you have various open source layers on top of that are still permissionless, still open source, still non-custodial, but that are faster and have other trade-offs. And then you have custodial arrangements that you can choose to have some of your money. So for example, I can have an environment where maybe every quarter I pull my surplus back into my cold storage savings with one transaction, but I'm fine with leaving, say, the past month of earnings or the past couple months of earnings in my checking account type of environment on this more custodial type of platform. And so basically in that world, you choose your own layer of what makes sense to you. If you've got, if you're in a developing country, you've got the equivalent of, $500 worth of savings, you want to make payments, you're maybe not, you're not thinking of like Michael Saylor level of security here, right? You're not like, how are you going to store $1 billion worth of Bitcoin? You're thinking, okay, how do I not get rug pulled? How do I make transactions? What is efficient? How do I save on fees? That kind of thing. If they start to build surplus savings, then they might start thinking more about security and pulling that deeper towards them. Whereas if you're an intermediate level size person, maybe you have thousands of savings, maybe you do pull that into your own storage from time to time, or pull it into at least like a deeper layer, maybe a federation instead of a single custodian. Maybe pull it into a very well audited and very well proven custodian, for example, rather than one of those faster environments. So I think the point in that ecosystem is that layers greatly extend the speed of transactions that can occur, and you choose your own layer that makes sense for what you're trying to do. And you can operate on multiple layers simultaneously. So your savings layer and your payment layer can be two different layers.